This here is the Buffett indicator. It's corporate equities versus the GDP of the US. And that's how Warren Buffett basically values if the stocks are cheap or expensive. The mean that he has is 69.9%. You are now sitting at 126.3% up. This year was in the 2001 crisis, this area here, and the market went down, okay? And this here is when it was the 2008-2009 subprime crisis in the US and came down all the way to 59, okay? But in the meantime, as you can see, the mean is 69.9, or say 70%, and it's sitting at 126.3%, which means that the stock market is overvalued according to Warren Buffett's metrics. On this chart shows the Shiller P ratio, which a lot of people follow, and it's measuring from 1890 all the way through to 2010 and onwards, okay? Currently, from the 12th of August, the PE ratio, the Shiller PE ratio is 27.08. The mean is 16.68. So again, this is showing you that the stock market, according to the Shiller PE ratio, is overvalued. This was again the overvaluation that existed when it was the 2001 crisis. And yeah, these dots here shows you when the stock market had a major correction, the Black Monday and the Black Tuesday stock market correction. This chart is the S&P 500 PE ratio, okay? And here it shows you the PE ratio on the S&P 500 stocks, and you can see on the 2010 more or less, which was actually before, which is 2008, 2009. That's where it was, and then corrected all the way down, okay, when it was the global crisis. But now we are sitting now at 25.27 PE on the average share in the S&P 500, but the mean is 15.60. So again, you're getting overvaluation on the stock market. Just as an interest, on 2009, the PE was 123.73, totally overvalued. The only way that basically the GDP of a country or growth on the country is if people incomes grow over time, so then they have more buying power and they can spend their money. But here in this chart, it shows you the US median income growth rate measured from 1978 all the way through to now. Well, in actual fact, in this chart, which was updated, the latest date was December 2014. And this is the income growth rate in America. It's just continuously been going down. And now it's been going down to 0.13%. But the mean, again, is 4%. So how can the economy grow if people's incomes are being reduced and going down? On this chart, you're looking at the US labor force participation rate. When you see the figures coming out, the unemployment rate in America, those are all rigged, they're all lies. You got to look at this figure here, the force participation rate. This tells you the truth of what's happening, if people are really getting jobs and working, or is it going down. In this case, as you can see, from 2000 onwards, it's been going down, and it's sitting, the participation rate now at 62.70%, okay. So it's below the mean, which is 62.88. So it's actually it's continuously going down. So no matter what they say, that jobs have been created in America and everything's going on well and there's economic growth then because everybody's getting jobs, this is not true, okay. And this was the latest figure, was actually in July the 8th, 2016. On this chart, it shows you the dollar and gold ratio, okay, from 2007 to now, okay. And here you can see where it was on this gray area was when it was the global crisis in 2008 2009, and it went down. So in other words, the Dow went down against gold, okay, and here was actually the bottom. So in other words, gold, the valuation of gold was more in true reflection against the Dow. But so far, from the middle of 2011 onwards, okay, it's gone up to this area here. So again, it's telling you that gold is starting to become undervalued against the Dow. So again, it's telling you that the Dow stock market is overvalued. This is another indicator that I look at. So we're concluding now, and as I've been mentioning earlier, the stock market is very expensive. Stocks are very expensive, so they should be going down. The only thing that's going to be going up, and it's already started reflecting, okay, is the Dubchicks monthly index that measures the real value of gold since 1982. Okay, and this is the correction in gold coming down in 2014, 2013. Okay, and since 2014, the real value of gold is going up, and I'm expecting it to carry on going up as the stock market corrects down.